Imagine you have a choice to make today. Option A, you are stuck in absolute gridlock, just bumper to bumper rush hour traffic for an entire hour. Option B, you sit down at your computer, in the comfort of your own home for that exact same hour, and you rebalance your investment portfolio. Which one are you picking?
Well, I mean, logic dictates you take the hour at your computer, right?
Hmm.
You're comfortable, you're proactively managing your wealth, and you aren't breathing in exhaust fumes.
You would think it's a total no-brainer, but according to a Wells Fargo and Gallup survey we're pulling from today's stack of research, 31% of investors would actually choose the traffic.
Wow, seriously?
Yeah, nearly a third of people would rather sit in a miserable honking commute than spend that exact same amount of time maintaining their investments.
That is a staggering statistic. But, honestly, it speaks volumes about the just the psychological dread people associate with portfolio maintenance.
Right. It's essentially the financial equivalent of taking your car in for routine maintenance. Nobody wakes up thrilled to go get their tires rotated. It feels like a chore. It might cost a little money up front, but you know it's essential so you don't end up stranded on the side of the highway.
Yeah, and what's fascinating here is that human psychology actively works against good portfolio maintenance.
Yeah.
It sets up this incredible friction between, pure mathematical logic and our emotional biases.
And that friction is exactly what we are dissecting today. Welcome to the Deep Dive. I'm your host, and we have a towering stack of sources to go through for you today.
We really do.
We're looking at historical data from Vanguard, long-term studies from the AABRI, some really unique research on German households from Bamberg University, over 3 million simulations from a researcher known as the Poor Swiss, and some intense debates pulled straight from Reddit's Bogleheads and other investing forums.
It is a phenomenal cross-section of data to dig into.
Yeah, and our mission today for this deep dive is to figure out the true pros and cons of rebalancing. We're going to explore whether handing it all over to an automated algorithm is like a stroke of genius or a hidden tax trap. And ultimately answer the big question, does rebalancing actually make you more money? Or is it secretly dragging down your returns?
Well, to get to the bottom of that,
Yeah.
I think we first need to look at the actual mechanics of what rebalancing forces you to do and why that makes investors so deeply uncomfortable.
Right, let's establish the baseline here. Most of you listening already understand the concept of portfolio drift. But just to be clear, if you start with a simple two-fund portfolio, say, an equal split between Apple and Microsoft, and Apple goes on this massive run while Microsoft just kind of trades sideways, your portfolio is no longer balanced.
Precisely. Your wealth is now heavily skewed toward Apple,
Right?
which means your risk is incredibly concentrated.
Right.
So to rebalance back to your target, you have to sell a portion of your Apple shares, your big winner, and use that cash to buy more Microsoft, the stock that has been, just flatlining.
Okay, let's unpack this, because from a pure gut reaction standpoint, this feels completely counterintuitive.
Oh, absolutely.
If I own a racehorse that is winning every single race, I don't chop off its legs to go buy a slower horse. I mean, why would you want to clip the wings of the very asset that is actually driving your wealth? Aren't you just punishing your winners?
It absolutely feels that way, which, going back to your intro, explains the 31% of people choosing rush hour traffic.
Right.
But if we look at the underlying market mechanics, you are systematically forcing yourself to execute the one rule every investor knows, but rarely follows. You are forcing yourself to buy low and sell high.
Because Apple's valuation is currently stretched and Microsoft is relatively cheap.
Exactly. You are taking profits off the table from an asset that has become really expensive and accumulating an asset while it's heavily discounted.
Okay, that makes sense on paper.
But beyond just valuation, you are resetting your risk profile. I mean, if you let Apple become 70% of your net worth, and then Apple misses earnings the next quarter and drops 20%.
Your overall portfolio takes a devastating hit.
Right. Rebalancing ensures your exposure to a catastrophe that stays exactly where you originally designed it to be.
But if the goal is to optimize your portfolio, this brings us to a really uncomfortable revelation in our sources. It comes directly from a Vanguard study spanning from 1926 all the way to 2014. And this data might actually validate every instinct you have to just leave your portfolio alone.
Yeah, the historical numbers here usually shock people.
Vanguard looked at a portfolio that started as 50% stocks and 50% bonds. They tracked one version of this portfolio that was never rebalanced for those 88 years.
Not even once.
Right, totally ignored. And unsurprisingly, because equities compound faster than fixed income over decades, that unrebalanced portfolio drifted heavily. It eventually averaged out to holding 81% stocks,
Okay.
and it yielded an annualized return of 8.9%.
Which is a phenomenal run over nearly a century.
It is, but then they looked at the exact same starting portfolio, only this one was systematically rebalanced every year to stay right at that 50-50 split. That rebalanced portfolio yielded an 8.1% return.
Wow.
Yeah. The portfolio that was completely ignored actually generated more wealth.
And this strikes at the heart of a major debate in the investing community, often referred to as the Boglehead paradox. It's named after Jack Bogle, the legendary founder of Vanguard, and the inspiration for the classic three-fund portfolio.
Oh, right. And for those who might not follow the forums, the three-fund portfolio is essentially building your entire strategy out of a total U.S. stock fund, a total international VIDOC fund, and a total bond fund. It's like the holy grail of simple investing.
It really is. And Jack Bogle himself often advised against strict, continuous rebalancing.
Wait, really? The pioneer of the index fund, the guy who basically built Vanguard, told people not to rebalance. How does that reconcile with modern portfolio theory?
Well, it's all about the mechanics of compounding. Over long time horizons, the stock market inherently goes up. So if you are constantly selling off your high-performing equities to buy conservative bonds, you are structurally capping your upside.
You're getting in your own way.
Exactly. Bogle's philosophy was that letting it ride allows the natural upward momentum of the market to compound uninterrupted. As the Vanguard data proves, if you measure success purely in total dollars at the end of a century, letting it ride wins.
So if Vanguard's own data proves that doing nothing makes you more money, and Jack Bogle says let it ride, why does, every financial advisor on earth tell you to rebalance? Is the whole concept just a trap?
No, it's not a trap, but this raises the most crucial distinction in finance. The difference between maximizing your absolute return and controlling your volatility.
Okay, go on.
Rebalancing is not designed to give you the highest possible number in your brokerage account. That's a common misconception. It is strictly a risk management mechanism.
Explain how that mechanism works in the context of those Vanguard portfolios. Because an 8.9% return just inherently sounds much better than 8.1.
It does, until you look at the standard deviation, which is the metric we use to measure how violent the price swings are.
Right.
That unrebalanced portfolio that drifted to 81% stocks, it had a standard deviation of 13.2%. It was a massive roller coaster.
Ah, okay.
But the rebalanced portfolio had a standard deviation of just 9.9%.
So it was a much smoother ride.
Significantly smoother. And the research affiliate study in our sources puts a really sharp point on why this matters. They note that if you let a standard 60-40 stock-to-bond portfolio drift until it hits 80-20, your expected volatility spikes by 30%.
Wow. And I mean, a 30% spike in volatility is fine if you're 25 years old and you don't need the money anytime soon, but it's terrifying if you're 65.
Exactly. It's called sequence of returns risk. If a severe bear market hits right as you retire, and you need to start withdrawing cash to live, that unrebalanced, equity-heavy portfolio is going to suffer catastrophic, basically unrecoverable losses.
Because you're selling at the absolute bottom just to pay your mortgage.
Right. So rebalancing is the price you pay for predictability.
You are trading a fraction of your absolute top-end return for a massive reduction in stomach-churning volatility.
Yes.
But how does this play out over a realistic investing lifetime? I mean, most of you listening aren't investing for an 88-year unbroken stretch like that Vanguard study.
No, of course not. We have to look at shorter, more practical time horizons. And the research affiliate study does a brilliant job of breaking this down by looking at rolling 10-year periods across the U.S., the UK, Germany, and Japan.
Yeah, I loved this part. They introduced these 3 distinct investor profiles to test the historical data, which I found incredibly helpful. First, you have Methodical Mary. And she represents pure discipline. She systematically rebalances her portfolio back to its target weight every single year, regardless of what the news is saying.
Right. The textbook emotionless approach.
Then you have Wait and See Will. And honestly, Will is basically all of us. He rebalances sporadically. If the market feels unstable, he skips his annual rebalance and just waits for the dust to settle before making a move.
He lets his psychology dictate his strategy, which is super common.
And finally, you have Drifter Drew, who sets his initial allocation on day 1 and literally never touches it again. Pure let-it-ride philosophy.
The Bogle approach.
Exactly. So over all those rolling 10-year periods across all those global markets, who actually wins? If we look at risk-adjusted returns, which is measured by the Sharpe ratio, Methodical Mary wins 79% of the time.
That is a definitive victory for discipline right there. And the Sharpe ratio is crucial here because it basically asks, how much return are you generating for every single unit of risk you take?
Right, efficiency.
Exactly. By constantly resetting her risk profile, Mary gets the most efficient growth possible. Grifter Drew might occasionally end up with more cash, but he took on a disproportionately huge amount of risk to get there.
But what if we stretch the timeline to 20 years? Because the Academy of Accounting and Financial Studies Journal, the ABRI, published a study looking at 2-decade horizons. And they introduced another behavioral strategy into the mix, which they called the Chase portfolio.
Oh, the Chase portfolio is the ultimate behavioral trap.
It really is. For those who don't know, the chase strategy is when an investor looks at whichever asset class had the highest return last year and then shifts all their money into that specific asset for the current year.
It's the literal definition of buying the hype.
And the AABRI study found that over 20 years, the chase portfolio is an absolute disaster. I mean, it just destroys wealth.
Yeah, and the mechanism behind why it fails is important to understand. Markets are cyclical, right? So if an asset class was the absolute top performer last year, it has likely already peaked in valuation.
Right.
So by chasing it, you are systematically guaranteeing that you buy at the top of the market right before the inevitable correction.
You're buying high and selling low, the exact opposite of what you should be doing.
Exactly.
The study ultimately concluded that for a 20-year timeline, a systematically rebalanced portfolio that maintains a minimum of a 45% stock allocation is the scientifically superior way to protect and grow wealth.
And notice that minimum 45% stock allocation. That's key. Even when you are optimizing for safety, you still need enough equity exposure to outpace inflation. Rebalancing just keeps that growth engine from turning into a runaway train.
So the best analogy I can think of here is that rebalancing is like driving on the highway with your seatbelt securely fastened while strictly obeying the speed limit.
Oh, I like that.
Right. Yes, Drifter Drew might reach the destination slightly faster by speeding down the back roads if everything goes perfectly, but methodical Mary's odds of actually surviving a severe crash go way up because she has her safety measures actively engaged.
That perfectly captures the risk-reward trade-off. It really does. So if we accept that methodical Mary's disciplined, unemotional approach is the mathematically sound way to manage long-term risk, the logical next step is to ask, shouldn't we just automate this?
Exactly. I mean, we live in the future. We have robo-advisors. We have target date funds, which, for anyone unfamiliar, are mutual funds that automatically shift your money from risky stocks to safer bonds as you get closer to your retirement year.
Right. Set it and forget it.
The article from the Money Cog in our sources lists some very compelling pros for putting this all on autopilot. First, it removes the emotional pain of selling your winners. Second, it saves you time. And third, it's cheap compared to a human advisor, usually costing around 0.5% in fees.
Sure, on the surface, a target date fund or a robo-advisor sounds like the absolute silver bullet. But the Money Cog also dives into the hidden traps of automation, and they can be pretty severe.
Uh-oh. Like what?
Well, first, rigid automatic rebalancing contradicts a pure buy-and-hold momentum strategy. I mean, an algorithm doesn't care if a specific sector is in the middle of a historic fundamental breakout. If it crosses a preset threshold, the computer just blindly sells it.
It has literally no context for the macroeconomic environment.
None. Zero. But honestly, the far more dangerous traps are the structural ones. Transaction costs and tax drag.
Let's get into the tax drag because this is where investors really bleed out without noticing.
Yeah, it's a silent killer.
Yes.
So if your automated portfolio is sitting inside a tax-advantaged account like a 401k or a Roth IRA, you are generally insulated. You don't pay capital gains taxes on trades made inside those specific wrappers.
Right, you're protected.
But if you have a robo-advisor managing a standard taxable brokerage account, the mechanics totally work against you.
Because every time it makes a move, the IRS wants a cut.
Precisely. Every single time that algorithm decides your Apple stock has grown too much and automatically sells a fraction of it to buy bonds, it triggers a capital gains tax event.
Ouch.
And if we enter a period of high market volatility, that algorithm might be trading constantly just to maintain its strict parameters.
It's just churning the account.
Yes. It is racking up tax liabilities and transaction fees that silently eat away at your compound interest. You might be perfectly balanced, but your net returns are getting shredded by the taxman.
Wow. So a one-size-fits-all algorithm really isn't perfect. And there's another fascinating wrinkle to this automation debate. We have this really cool deep dive study from Bamberg University that analyzed the actual multi-layered portfolios of German households.
Yeah, this data is incredibly revealing because it looks at assets outside of just standard stocks and bonds.
Right. They found that while rebalancing reliably improved the risk profiles for households heavily invested in highly liquid assets, stocks, mutual funds, even standard real estate, there was a glaring exception. Households that held a high percentage of what the study calls articles of great value.
Which basically means illiquid assets, fine art, rare collectibles, high-end jewelry.
Exactly. For those specific asset classes, attempting to rebalance actually caused the portfolios to perform worse. So why is the math breakdown there?
Because the friction of the trade destroys the benefit of the rebalance.
Explain that.
Well, articles of great value operate in highly illiquid markets with massive bid-ask spreads. You can't just log into an app and sell 10% of a rare painting to buy more index fund.
Right, you're selling the whole painting.
Exactly. And the auction house fees might be 20%. The appraisal costs, the insurance, the sheer time it takes to find a buyer. That friction completely annihilates any mathematical advantage you might gain from rebalancing.
It proves that you can't just blindly apply a mathematical formula to every type of wealth. It requires a lot of nuance. So if rigid automation has hidden tax traps and illiquid assets require a totally different approach, we need to give you a practical, data-backed blueprint. How often should you actually be rebalancing to get the risk management benefits without getting crushed by the friction?
Yeah, the debate over frequency is one of the most contentious in finance. I mean, do you check it daily, monthly, quarterly, or yearly?
Right. And the Poor Swiss study in our sources sought to definitively answer that. And they didn't just look at a couple of historical bull and bear markets. They ran over 3.2 million Monte Carlo simulations.
Which is a crucial methodology to point out. Monte Carlo simulation essentially stress tests a financial strategy by running it through millions of randomized market conditions and randomized sequences of returns.
So it completely removes the luck of historical timing.
Exactly.
So after stress testing withdrawal rates and timeframes over 3 million times, the staggering conclusion is that historically, yearly rebalancing is almost universally superior to monthly rebalancing.
Which is deeply counterintuitive for a lot of investors. I think a lot of people assume that more active management naturally leads to better results.
Yeah, if I'm paying closer attention, I should do better, right?
You would think, but mathematically, monthly rebalancing is a trap. First, if you rebalance every 30 days, you are constantly incurring those transaction fees we just talked about. But more importantly, you are interrupting the natural momentum of the market.
Break down that momentum concept for us.
So, market trends tend to persist in the short term. If a particular sector has a breakout quarter, it often continues to run for several months before correcting. If you rebalance monthly, you're constantly chopping off that upward momentum before it can fully materialize.
You never let your winners actually win.
Right. By stepping back and only rebalancing annually, you give your assets enough breathing room to capture those sustained runs, while still putting a firm yearly cap on how far your risk can drift.
But even annual rebalancing might trigger unnecessary taxes if the market has just been, flat for a year. That's why both Vanguard and Fidelity advocate for a strategy they call the hybrid approach.
And the hybrid approach is brilliant because it marries the discipline of methodical Mary with extreme efficiency.
The rule is remarkably simple. You monitor your portfolio on a set schedule, say, once a year. But you only execute a rebalancing trade if your asset allocation has drifted beyond a specific predefined threshold. Fidelity, for example, suggests a 5% threshold.
And the mechanism here is what makes it so powerful. If your target is 50% stocks and 50% bonds, you log into your account on your designated day once a year. If your stocks have only drifted up to 52%,
You do absolutely nothing. You close the laptop.
exactly. You only execute a trade and trigger those potential taxes if your stocks drift past 55% or drop below 45%.
It completely respects your time. You aren't obsessing over daily fluctuations. You use those 5% guardrails, and you only act when it is mathematically necessary to pull your risk profile back into line.
It's the ultimate middle ground. It minimizes your tax drag, it slashes your trading fees, and it honestly protects you from the emotional fatigue of constantly tinkering with your life savings.
So, to summarize the absolute wealth of data we've covered today, rebalancing is not a magic formula for unlocking higher returns. It might occasionally force you to trim your biggest winners, and it might cost you a fraction of those absolute top-tier 80-year gains.
Right.
But it acts as the ultimate shock absorber. It keeps your exposure to risk exactly where you decided you wanted it, so when the market inevitably drops, your portfolio doesn't just shatter.
That is the perfect takeaway. But before we finish, there's one final incredibly empowering strategy buried in the sources that I think you should really explore on your own.
Woo! Let's hear it.
What if you could get all the structural risk management benefits of Methodical Mary without ever selling a single stock, thereby avoiding capital gains taxes entirely?
Wait, if you don't sell the assets that have grown too large, how do you mathematically rebalance the portfolio?
It's a technique called cash flow rebalancing. Instead of selling your overperforming assets to buy the laggards, you simply redirect all of your new incoming cash, so your ongoing 401k contributions, your monthly deposits, or even just the dividends your investments naturally generate, solely into the underperforming asset class.
Oh, wow. That is incredibly clever.
Yeah. If your stock allocation has drifted too high, you don't sell a single share. You just route all your new monthly savings exclusively into your bond fund until the ratio naturally dilutes back to your original target weight.
So it requires some patience.
It does, but it is an invisible, highly efficient way to maintain your risk profile with zero transaction fees and zero tax penalties.
It's like adjusting the sails on a boat to catch the wind perfectly without ever having to drop the anchor and stop your forward momentum.
Exactly.
You keep your portfolio gliding smoothly, you bypass the tax traps entirely, and best of all, you never have to choose between managing your money and sitting in rush hour traffic again.
Exactly. You let the current do the work for you.
That is a phenomenal strategy to look into. Thank you for joining us on this deep dive. Take a look at your own guardrails, see if cash flow rebalancing might work for your accounts, and we will catch you on the next one.